Good day, everyone. This is James Bennett, Global Equity Analyst at Anchor Capital. Just a quick discussion on Fortinet's Q4 24 financial results that were released a few days ago. This is a company we like a lot. Followed this company for many years. If we look back in 2024, Fortinet was up 61%, outperformed the other stocks in this sector. Not the same share is going to win every year, but certainly Fortinet has been a very consistent performer over the years. If we look year to date this year, it's up about 18% year to date. So it's again having a very strong year on the back of the year that it had last year. The recent results were excellent. Beat the results comfortably on every level. Probably the standout was the 33% margin guidance that had been given by the company before, and they ended up reporting about 39%. And a very big beat on earnings as well, which grew about 45% year on year. Record margins of 39% for Fortinet at the end of last year almost puts them in league with an ultra luxury company like Hermes, which has got about a 40 to 42% margin. Bearing in mind that this business does have seasonality, Q4 is always their strongest quarter of the year, so you will see some pullback in the first quarter of this year, but nevertheless a highly profitable company. There's no one cybersecurity company that is absolutely dominant in everything in cybersecurity, but when it comes to hardware, I would say Fortinet are pretty much top dog. Their market share is huge on a volume basis, and even on a value basis, they still come out on tops. And they're the only cybersecurity company out there that actually design their own custom chips, which helps them from a supply chain management, and it also gives them the best performing boxes in the market as well. There's a very exciting cyclical development that's underway at the moment, and that is that there's a very high number of Fortinet boxes that are going out of their service life in 2026 and 27. That means they're no longer supported by the company. And what that means is that starting right about now, corporates are going to have to start ordering new boxes when their current ones are facing the end of their useful life. People don't leave it until the very end, so we already saw in Q4 24 that there was a pickup in orders from larger companies. Hardware accounts for about 30% of Fortinet's revenue. The other 70% is software, although some of the software they sell is the service contracts related to the sale of these physical boxes. Fortinet is an exceptionally well-run company. Within the cybersecurity companies, we would say it's probably the best run of all of them in terms of its focus on returns, strong free cash flow generation, very low stock-based compensation. They do buy back shares from time to time, but they're very sensitive as to where the price is. When they pause their share buybacks, then their net cash, as we show here, starts to rise quite quickly. So at the end of last year, they had about $3.1 billion in net cash. And this next chart just shows how that in the last year, in response to the higher share price, they have actually paused their buyback, even though they have about $2 billion still allocated. This slide gets a little bit technical for those who don't follow the sector, talking about Universal SASE. Universal SASE is really SD-WAN plugged into SSE. Now, when it comes to SD-WAN, Fortinet are the absolute global leaders in that area. SSE, they've been relatively small up until now, but they've rolled out some very compelling products in the space, which really makes them a one-stop shop in Universal SASE. And it's an area of their business that continues to gain some good market share. No investment cases without risks. There's some tariff risk to Fortinet. They're a very global business. About 60% of their sales are outside the US. They do sell in Canada and Mexico, and they also source some hardware from the rest of the world as well. So they themselves don't really know what the impact will be at this stage, but it could have some impact. By its own history, I wouldn't say Fortinet is expensive. It's not as cheap as it was 6 months ago. And this is an interesting case study if we look at this chart, where going back many years, Fortinet has never really traded below a 1-year forward 30 times price to earnings ratio. And one could say that it's averaged somewhere between a 30 and a 50 multiple. So the current 1-year forward multiple of 43 optically looks expensive, but actually it's within its own range. And notwithstanding what has appeared to be a high multiple over time, the share price has actually been a multi compounder and bagger over those years. And I just did a simple exercise here where I looked at the trailing share price some years ago over the 5-year forward earnings number. Obviously, we know now where those forward earnings would have ended up being. And you can look back before 2020 that, yes, the share looked expensive, but if you look on the bottom line, it's consistently traded in a single-digit PE on its 5-year forward earnings. So, the market has a very good way of pricing in these more futuristic type of shares. There's the 1-year forward PE of 43 times. Again, optically, it looks a bit expensive, but actually, by its own history, it doesn't look too bad. And then the other thing to bear in mind with Fortinet is that over the years, it's had a lot of earnings upgrade momentum over time. So sometimes, it would look like the share's a bit expensive a couple of years out, but then over time, the market upgrades those forward earnings estimates such that the share ended up not being as expensive as it might have appeared in the past. This is a company we like. Yes, it's run hard. Maybe we need to temper expectations a little bit from here, but this has been a great cybersecurity company to own over the years. Thank you very much.